All right.
Well, it's just us two now. So
Yeah, it's just us. Where's Logan?
In his room.
Okay.
He's in his room.
Okay.
All right. Well, welcome back. This is episode. I have no idea.
40.
40. Is it really?
Big 40.
Episode 40. We are. This is off the cuff. Jared explaining valuation of Monster Energy.
There you go.
And yeah, that's what we're doing today. He's going to go through the financials and enlighten us on what this means and what. Yeah, that's it. Actually, what it means, pretty much.
That's about it.
What it means.
I was waiting. I was like, oh, what else am I gonna do?
What it means and what it means.
That's about it. Yeah. So usually we talk about shit, but me and Max are going through some shit, so we don't want to talk about anything. We want to get this episode done and fucking packed away.
Produce.
All right. Yeah. So we're gonna go over something called a discounted cash flow, and that is pretty much it's a very commonly used tactic and whatever the fuck you want to call it, whatever.
Valuation.
It's a very commonly used thing in investing on Wall Street, although they use it a little bit differently. You know what they do, Max? The only thing they do that's different is I'm going to explain the discount rate. They use something called the weighted average cost of capital. And it's because they're not really looking for they're not really looking to value it as an investment. They're looking to value the company literally.
Okay.
So they're not looking to like, okay, if I pay this, that's what I'm going to get in return. It's literally, okay, this is what this thing is worth.
Yeah. So when you say discounted cash flow statement, correct me if I'm wrong. I think it's just basically what its present value is. What is this company worth like right now based on what it produces in the future, what revenue it creates, what profit it makes. And you're basically just saying what is the maximum I should pay for it now to get these returns.
Yeah, pretty much. And I want to make one thing clear. I don't know what the future is going to be. I don't know what it's going to look like. We're going to do Monster right now, and Monster is very consistent. However, you have no clue what's going to happen.
This does not account for coronavirus per se.
Exactly. This does not account for literally anything that could happen.
This is a war. Right. This is basically if every single thing in the universe stays the same. This is what this company will produce.
Right.
No president change, no nothing. So you're just literally looking as if the company is the only thing that matters in this universe.
So we're doing Monster Energy, and I'm going to go through it right now. So a DCF stands for discounted cash flow, and it's a way for an investor to project the cash flows of a business, the future cash flows of a business. And what you do then is you pick a certain rate and you discount those cash flows, those future cash flows back to the present day, like Max said. So you figure out a good price to pay for it based on that discount rate.
So this discount rate, it's basically like kind of like the return that you want on this, correct?
If you are 100% accurate, that discount rate theoretically will be the exact return you will achieve.
Right.
However, so like I said, it's never going to be like that.
Right.
Could be less. Could be less. Could be more.
Yeah. So it's basically saying that I'm discounting these cash flows by 15% because I want 15% rate of return on my investment.
Right. And over the long haul, the market averages what? 10%. So this is how I think of it. If I'm going to take on more risk and pick individual stocks, I want a premium. I don't want to get 10% because I'll just go put that in SPY and leave it. I want to get 15% because I want an incentive to invest in individual companies.
Right.
Yeah.
Because if you wanted just a market rate or risk-free rate, you would, like you said, it'd be SPY or a bond or whatever like that.
I would just put it in
premium. Yeah. What he means by premiums, you want more than market return.
Right. Yeah. Because I want an incentive to buy an individual company because I am taking on more risk. Shit can go to zero.
Exactly.
With SPY, it's tracking 500 companies. You're
Yeah.
pretty safe.
It's pretty,
You're pretty
it's
good.
pretty, if one shits the bed, not all 499 will as well.
Yeah.
So
Yeah. All right. So let's get right into it. This is mine, my templates, mine.
wow.
And
It looks gorgeous.
for the audio listeners, this may be a little hard, but I'm going to try my best. So basically I have 3 scenarios. I have a high growth, I have a medium growth, and I have a low growth scenario. It's basically, okay, what's the best scenario? What's the probably most likely scenario? And then what's the absolute worst scenario? So what you need is, you need the shares outstanding. In this case, Monster has 535 million. You need their most recent free cash flow number. In this case, Monsters is 1.46 billion. And then this exit to price to free cash flow multiple. This is basically at the end of 10 years. I believe this is what I can sell it at this multiple. It's no different than a price to earnings multiple or a price to sales multiple. It's just price to free cash flow because I'm using free cash flow. Got that?
I think that was when you explained this to me the first time, that was the one that I had the most confusion on.
So I don't know if I
name
have
for it
this.
sounds kind of weird.
So it's literally just think of it as a PE ratio, Max.
Okay, price earnings.
So exactly. Think of it as a PE
for
ratio.
what you get.
Yes. So Monster trades at historically, let's just say it trades at a 20 price to free cash flow multiple. So if it's historically 20 and it's very consistently 20, I have no reason to believe that it will change in the future. I mean, it will. It could go down. It could go higher. I'm not sure.
Yeah,
but
exactly.
if it's like consistently 20, in this case, I don't remember what it was, but I believe it was. I mean, I could open a new tab, but I don't know. Let's just stay with this.
A lot of this, it seems like we're obviously working with past numbers and everything like that. So you kind of just take like average, like consistently, what is it? Okay, let's apply what it is consistently or what it's been in the past and just say this is what it's going to be in the future. Like you're saying, it's not exactly accurate per se, but it's the best use for like future forecasting and stuff like that.
Yeah. It's all assumptions, and it's all like I said earlier, like you really don't have a clue what's going to happen, but that's why I'll explain at the very end what the most important part of valuing a company is. And Max, I'll say it right now, it's the margin of safety, and it completely like just offers you a tremendous cushion for potential mistakes, because I'm not going to be right. I'm not going to be 100% right in this valuation. I'm not going to be 100% right in the high, the medium, or the low growth. I'm going to fuck up somewhere because I'm human. It's going to happen. So the margin of safety is like, okay, yes, you fucked up, but you bought it so cheap that you're going to be fine. You're going to be fine. Okay. So price to free cash flow multiple, it's literally just a multiple, just like PE, just like price to sales, just like anything. It's just the price it trades at in relation to its free cash flow. That's it. This discount rate is the rate of return that I want to achieve. And I'm choosing 15%. I don't really have an exact reason why. It's literally just because Phil Town fucking taught me to use it. That's literally it. And when you think about it, 15%, and it's the more I value companies, the more I realize 15% is a very conservative percentage that I want, because it's low. Like not the percentage is low. I'm talking about the price I have to pay to get that. It's a low price. It's if a company gets there, like I got lucky pretty much.
Yeah.
So if you go like 20%, 26%, you're not gonna fucking find anything.
Right, because you have to buy it at such a low rate or low price to get it to that kind of rate of return.
Yeah. The higher return you want, the lower the price you want. The lower the price you're gonna have to pay. The lower return you want, the higher the price you can pay. If I put this thing at 1%, if I put this thing at 5%, I'm sure it's probably a buy right now. But net debt in parentheses, I should label this. Net debt is literally the amount of debt that Monster Beverage has, and in this case they have more cash than debt, so I add that cash down into its intrinsic value because they can invest that cash and grow their company and things like that. If they had more debt, I would subtract it from their intrinsic value.
Makes sense.
Okay, so Now with the growth rate. So if you look over here, revenue growth has been 11% average 10 years. Equity growth 21%. They have a very high return on invested capital, meaning the money they return, the money they invest in their company is, so for every dollar they invest in their company, they're getting like 28.89, like 28 cents and 89, whatever the fuck. So for every dollar they're getting 29 cents. Let's just call that. For every dollar they invest, they're getting a return of 29 cents, which is really good.
You're pulling this straight from their financials, all this information right here.
Yeah.
Right.
Yeah.
Yeah. This isn't stuff you calculate or anything.
Yeah. This earnings growth, 16.5%, free cash flow, 14 or practically 15%, return on equity. Return on equity, Max, will be the same thing as return on invested capital if the company has no debt. And like I said before, they don't have any debt. So that's why these are the same. Return on equity is return on the equity in the company, and return on invested capital is return on the equity and the debt that they invest into the company.
Right.
If you have no debt, it'll be the
Same.
same. Yeah. Net income growth, 15.5%, operating cash flow, 16%. So for this right here, for this DCF, discounted cash flow, I'll look at all of these. I'll look at the revenue. I'll look at the equity. I'll look at the free cash flow. I'll look at the earnings. I'll look at the net income, and I'll look at it and I'll be like, okay, what's a good conservative but reasonable percentage that I think they can grow at in the future? And obviously that this takes more research. You want to know what the company is going to do in the future and what they have in store and things like that. But to make it simple, look at these percentages: 11, 21, 15, 16, 15, and just come up with a reasonable growth rate to put into your DCF. And for the high growth, let's just focus on the high growth right now. I put 15% for years 1 to 3. I put 15% for years 4 to 6. And then I dropped it down to 10% for years 7 to 10. So what I'm going down now, the first line of the discounted cash flow is the most recent free cash flow number. So you always start off with that. And then it'll grow by, and then it'll this thing right here, this growth rate formula, pretty much
Good luck, pretty much fucking listeners.
Yeah. It's pretty much 14. It's 1.4 billion, 1.46 billion times 1 plus the growth rate. So
and you do that year on, like
you do that year after year.
Yeah.
So at the very end,
you're just basically saying it'll grow by this percentage, this growth rate every year.
Exactly.
Whatever it started at.
Yeah. So the future cash flow value, no discount rate yet. This is just future cash flow growing by 15% for the first 3, 15% for the next 3, 10% for the next 4. Yeah, 4.
I was like, where did he stop? Where did he stop at?
Okay, so the future cash flow based on my assumptions for the high growth is $85.98 billion, which is a lot. Now, this right here, this column, present value, this will take the future cash flow number and discount that by 15%. So you go all the way down. It's always discounting this number by 15%. That's the time value of money right there. It basically means $1 today is worth $1 tomorrow, because you can invest that $1 today and get more on that $1, blah, blah, blah.
Right.
So this call it 86. This $86 billion of future free cash flow after 10 years, 15% discounted in 10 years, is only worth $21.2 billion. And so the net present value of future cash flow, meaning all of that added together, all of this present value column added together, is $33.4 billion. And this is where I go. Right after that, I go to current value. I don't think it's 93. I think it's taking a little dip, but it might be I think it's like 91.
Wait, what monster's that right now? It's 91 right now.
91. Okay. So
91 and some change.
The current value, the current share price of Monster is $91. The current market cap is around 48 billion. The intrinsic market cap is, so this takes right here, the net present value of future cash flows, and it subtracts, and in this case, it's adding the net cash which is whatever that is, fucking 2.5 million.
Something like that.
So the intrinsic market cap is, call it $36 billion. And remember, right now, the current market cap is $48 billion. So right there, that screams it's a little bit too expensive right now. The intrinsic share price based on that market cap, you just take that market cap and you divide it by the outstanding shares, $67.20. That's if I want a 15% rate of return. Now, this is what I talked about earlier. If you want a margin of safety, you have to pay less than that. So to get 15% rate of return, you have to pay $67 based on these assumptions right here.
Mm-hmm.
If you want, and that's without a margin of safety. So you better bet your research and your numbers are solid, because you don't have any downside protection or anything like that. If anything goes wrong in the company, you're kind of screwed. You have to be like absolutely spot on with your numbers.
Right.
Now, this 50% margin of safety will take the intrinsic share price and just divide it by 2, get half of it. And if I wanted to get a 15% rate of return and pay half off, I have to wait for Monster to go to $33. Now, that sounds really bad.
It's
That
really
sounds
fucking
like-
far from that right now.
That doesn't sound too good. Doesn't sound too promising.
The company might have to explode for it to.
Right.
No, I'm playing.
However, what I've learned by reading a lot and listening to a lot of people is 50%, while it's nice, it's not necessary. It's not necessary at all. This margin of safety number, again, I'm only using it because of Phil Town, and that's who I learned from. And it's just like, it's so, like, for example, Max, if Monster got to $33, bro, you're good. You're flying. And one thing I do want to let you know, if Monster got to $33, right, $67 would yield you based on these assumptions, $67. If you bought it at 67, you would get a 15% rate of return, because that's what you discounted the future cash flows by. Another 50% would that increase that, and you would have a 22.5% rate of return. Does that make sense?
Wait,
So
why'd you get 22?
Because 50% of 15 is 7.5. So you just add that onto it.
Oh, I see what you're saying.
So if you bought Monster at $33, you're looking at a massive margin of safety, and you're looking at a massive return on your investment.
Yeah. Upwards of 67%, right?
Yeah.
Something like
I
that.
mean, over the long haul, 10 years, technically, you should compound your investment by 22% over 10 years, which
22.
would be,
I went the other way.
which would be crazy. But this is it, man. So the medium growth, instead of 15, 15, 10, I go to 12.5, 10, 8, $55, 27. It's basically, if you want a margin of safety, anywhere from 33 to 25. If you don't want a margin of safety, anywhere from 67 to 50.
Mm-hmm.
But this is what's important about a discounted cash flow, is you can mess with these. If you don't want a 15% rate of return because you think that's like way too conservative and you're like, no chance Monster ever dips like that, let's just put a 10% discount rate. Scroll down. Look at that. Intrinsic share price is now $95. Technically, it's 5% on sale.
Yeah.
So, and even you can go even lower, or you can like change the assumption. So let's just say, man, Monster got this new drink coming out. It's going to explode the energy drink universe. They're going to grow by 20%. Cash flows will grow by 20%.
Oh, yeah, brother.
Next 3 years. Intrinsic share price is 103. You're trading at a 12% discount.
Look at that.
I mean, look at that. So
now the one thing that you said, and I know these, we talked to a couple guys before. I don't know why I can't remember his name. New Zealand. What was his name?
Tom.
Investing with Tom. He said, when you were dealing with this valuation, it is very easy to manipulate these to mentally work in your favor. If you're looking for a certain percentage rate of return, it's easy to fall into the trap of, okay, well, I want this rate of return. I'm just going to bump up. You know what? Maybe instead of years 1 through 3 at 10%, I could see it going, 20%, just because you want to move the number up a little bit, and you're
You
being
want
a
to
little
buy it.
bit, yeah, you're being a little bit ambitious on certain aspects of the company or certain growth rates. So it's easy to manipulate it a little bit in your favor, just to kind of make yourself buy it on the spot, I guess you could
Yeah.
say.
Yeah.
It's easy to fall into that trap. But if you're honest with your calculations and your valuation and your growth rates, it is a very, very solid starting place on whether to start a position or not into
Yeah.
a company.
Mm-hmm. Yeah, no, it's so easy to mess with these things because like Boston Beer Company, bro, it's it's fallen by over 60%. I'm gonna pull this one up. I mean, it's so discouraging to see that thing, dude. So, oh wait, I have to share my screen again. Hold up.
You have permission.
What's going on? Where's the Zoom? Okay.
Permission.
Host disabled participant screen share. You gotta let me do this. But yeah, like you said, while you're doing this, it's so easy. Just give me a thumbs up when I'm allowed to. It's so easy to manipulate these things in your favor because you just have a bias. You just have a bias with this company because you just spent weeks or months, researching this thing. And you're like, well, I want to buy this thing, dude. This thing's sick.
Emotionally.
Yeah.
Is where the emotional balance.
Right. And you
in.
have to stick to this process. You have to. So this is my little checklist. We're not going to go through that. She's
blank.
She's also blank. All right. So this is Boston Beer, my baby that I'm absolutely in love with. I adore. She's beautiful. Boston Beer shares outstanding is 12 million shares outstanding. Free cash flow is 113 million. Exit price of free cash flow multiple is 15. Discount rate again is 15%. Net debt, there you have 163 million of cash. This is a very up and down company. It's hard to get these numbers right. And this isn't a finished draft per se. This is just like a rough draft. Because let's just look at the growth rates real quick. 19, 22, 24, 13, 20, 22. Ooh, yeah. So let's make years 1 to 3, 20, and leave years 4 to 6 and years 7 to 10 through 15%. And this is remember, Max, it's fallen by 60% from its high. Look at the buy price. For those listeners, the current price, the price Boston Beer peaked at this year was $1,300. The current price is $500. If I wanted to get 15% return on my investment, I'd have to pay $235. So it would have to fall in half again, which is probably very unlikely.
Very, to say the least.
I would probably guess that won't happen.
You have to cut it in half and then cut it in half again.
You got to cut it in half and then cut it in half one more time.
Cut that half by half.
Yeah. So, and if I wanted the margin of safety, it's even lower. So it's $117 with a half off margin of safety.
Got a ways to go. Again, this company has to implode.
$100.
Jesus Christ.
Yeah.
It's overpriced is what you're saying.
It is, but it's only overpriced. And this is very important. It's only overpriced based on what I want out of it.
Right.
It's only overpriced based on this 15% rate of return that I want. I can put this at a 5% rate of return because this is why people say, this is why Warren Buffett says interest rates are what like gravity is to stocks, blah, 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 whatever. Because if the 10-year bond yield, risk-free yield is 1.4%, I'm not going to do that. So the lower the bond yield, the lower a lot of investors acceptable rate of return is, because if the risk-free rate is 1.4, they'll be like, the fuck? I can buy something for 4, 5 and be happy. You know what I mean? because I don't want to put my money into a 1% bond. I'll get
Yeah. But you're saying
Yeah.
as that bond yield rises to say 5%, then investors are going to want maybe 10%.
investors are going to want another premium. They're
Yeah.
if so, for example, if bond yields go to 5%, like you said, plus the inflation at 5% right now, that's already 10%. Investors are going to want a lot more. Right now, bond yields are at 1.4%, inflation at
Interest rates
5%.
are-
So let's call it 6 or 7%, which is below market average even, but it's still better than what you would get in the risk-free rate
right.
plus
right.
plus inflation. So instead of 15%, we're going to discount this free cash flow by 7%. And it's close. See that right there?
It is, yeah.
$422 as opposed to, what was it, 235?
Yeah, some along the lines of that.
Yeah. So it's close now. And even this margin of safety is still
That's what I was looking at.
$211.
That's what I was looking at. That's why I laughed.
But the intrinsic share price based on your return that you want at 7%, and you want to see this, Max. So Boston Beer has a very high price to free cash flow multiple. Like I'm talking stupid. Like I think I have it somewhere in this key metric thing. Price to free cash flow average 35. Okay. 35. And I have it at 15. Let's put it at 35 with a 7% discount rate. She's a buy, baby. She's a buy with a 36% margin of safety.
Right. Yeah. So when you manipulate these a little bit, and like you said, it's overpriced based on what you put in there, which is, again, like we were saying, it's easy to manipulate it to be in your favor if you're just honest with your evaluation and all that kind of stuff, and very on yourself to be not biased. This proves to be very valuable and honestly very reflective in what you get return wise.
Yeah. And look at this. Look at these price to free cash flow, the history 88, 233, 0, because it didn't have cash flow that year. 44, 25, 17, 32, 42, 49, 386.
You honestly could probably take that out because it skews it a little bit.
But so
that's
this
probably
one.
Why. Oh, I didn't even see that one. Yeah.
So let's do that. Let's do that right now. Let's just take these right here. Hello? Okay. 35. It's still 35. Oh, I think I did that. I think I did exactly.
Okay, I was
what
about
you
to
said.
say.
I think I did that. I think I did that.
That doesn't make any sense.
Okay. So without those massive, crazy,
that's still high as well.
35, 35, 15 is the market average for companies. 15 in a normal market. I would never be comfortable putting a 35 price to free cash flow exit multiple for anything, no matter the company, just because like you're going as bullish as these crypto motherfuckers are with Bitcoin. Like you're going like you're bullish as hell. So I'll put 25. I'll put 25 with a 15% discount rate. Still overpriced, but let's drop it down to a 10% discount rate. Nope, that's not right.
10%.
It's close. It's close.
Right.
And actually that's not a 10% rate of return in this market is not terrible. It's not terrible. However, you won't have a margin of safety if you buy at 474. Right. You'll have nothing. You'll have nothing.
No room for error is what you're saying.
No room for error, no room for miscalculations of any sort or anything like that. It's okay. I'm banking that this shit is right. I'm banking I know everything. That's what that's saying right there.
Fair enough.
Yeah. So just running through it again. You're basically in its most simple form. You're taking the free cash flow of a company. You're growing it by a percentage that you think it will grow at in the future. And then you're discounting those you're growing the future cash flows by a percentage that you think it'll grow out in the future. And then you're discounting that future cash flow by the return that you want to achieve in that investment. And that's it. That's it, man.
That was informative.
Yeah.
To say the least.
That's it.
That was the first educational one we've done in a while, strictly educational. And I think it is very educational. So that was good.
Yeah. And in this market, you're not really supposed to find a lot of companies that are trading at a good price. I mean, it's at all-time highs. It wouldn't make sense to find companies trading at good prices right now.
Right.
But yeah, you just gotta be patient, keep learning, and you have to stick to the process. You have to, like, I'll never change my my discount rate, because if I start changing that shit, then the whole process blows up, and then I don't even have a process. I'm free balling it.
In bias and everything.
I'm free balling it.
Fair enough.
No underwear on.
Not at all.
But yeah, you got any questions, bro? I
No,
think that was good.
I mean, I've been through it once, so it was a little bit easier to pick up, but
Yeah.
it does make sense.
It'll be
I
tough
think it
for
will
the
be
audio
informative.
people. Fuck them audio people.
Watch it on YouTube, damn it.
Yeah. I'll
100%.
make clips. This will be good clips.
Yeah. So that was, sorry, TikTok. That was episode 40. It sucks
was
as I was
episode
doing
40.
so good. That was episode
I
40. Yeah,
can't
that
be
was
bothered.
unreal. It's been a minute. We've been choppy in it, but we're here. We're trying.
Trying.
We are trying.
We're trying.
It actually definitely will get more consistent in the future again.
Yeah.
Season's coming to a close. Anyway, that is episode 40. Thank you for listening. God, this is weird doing the outro.
Go
What are we
for it,
on
bro. You're
now?
doing great.
We're on YouTube. We're on Instagram, not TikTok. We're
Not
on
TikTok.
not on
Apple
Discord.
Podcasts, Spotify, and YouTube.
And YouTube.
Yeah.
Yeah, so that's the epi, bro. That
That's
is
it,
the
man.
epi.
That's it,
Unreal.
man.
We're missing the outro, guys, but fuck it, dude. We're trying. We are trying. Sounds good. Thank you for listening. See you next time.
See you, boys.
Unreal.